Welcome, everybody. First of all, my name is Peter Lloyd, and I'm chairing the session. From Canary, Wharf to China, is the bubble going to burst again, is the title. So we're going to be looking at where these bubbles might be, where are the risks, what might the triggers be to another downturn, if there's going to be one, and we'll debate that point itself. Who or what might ride to the rescue, whether the measures taken since the crisis have covered up the underlying problems or perhaps even caused more, and will China throw up some more problems next time or be part of the solution? To help us shed light on these issues, I'm delighted that we've got an eminent and very knowledgeable panel of speakers who can look at the situation from a number of different angles. In order of speaking at the beginning, on the far left is Vicky Price, who is Chief Economic Advisor at the Centre for Economics and Business Research. She was joint head of the UK government's Economic Service and author of a number of books, including one which I was going to wave around, which is cool, I wouldn't need to do that, called Greekonomics, in which she said that the euro was misconceived and the idea that an exchange rate union alone would encourage prudent behaviour and convergence was laughable. Ultimately, the Germans will have to be a bit more like the Greeks rather than the Greeks being like the Germans. And I think it's correct to say that you are Greek, Vicky.
That is true.
On my far right is Phil Mullen, who's an economist and business manager, currently researching on economic trends in the Western world and writing a book on how Western economies have lost their mojo and what we can do to restore it. On my immediate right is Philippa Huckle, who runs her own wealth management business based in Hong Kong. Philippa is an international authority on behavioural finance, voted or nominated as Hong Kong's most extraordinary woman in finance in 2009. On my immediate left is Simon Nixon, Chief European Commentator of the Wall Street Journal, covering politics, economics and finance. He was executive editor of breakingviews.com, and in an article I saw actually in the US recently, he said that France's refusal to respect the Eurozone fiscal rules is shaping up to be a defining ideological confrontation with profound long-term consequences for the whole of Europe. So I'm sure we'll be talking about Europe and the Eurozone, so that's one way of introducing it. So I'm going to hand over to Vicky, if I may, for her introductory comments. Vicky.
Thank you. Well, thank you very much for this introduction. And yes, you let the cat out of the bag. Indeed, I am Greek-born, but funnily enough, I studied in German school. So I did my secondary education in German. So I have quite a lot of sympathy with some of the German views about some aspects, but not about how to deal with the recession that we've been through. I think it's a very interesting time to be talking about these things. I'll just lay the scene, the sort of economic parameters, if you like, in terms of what's been happening and why we are debating this particular subject right now. And I think what is interesting is that just in the last couple of days, we've had the markets fall back very substantially. There's been a bit of a pickup since, but the middle of the week was pretty horrendous. Loads of people probably lost quite a lot of money. Big values were written off equity markets because everyone became much more pessimistic suddenly about the outlook for the world economy, and particularly for Europe. What triggered it actually was a re-evaluation of German prospects. I mean, after all, Germany is a very significant player in Europe. It has been the strongest country in the Eurozone. Of course, the UK has been doing better recently, but within the Eurozone, everybody was dependent on Germany to do well. Germany's economic output recently has certainly disappointed. And in the middle of the week, they revised their forecast for this year to just over 1% growth, with a slight improvement next year. The result of that was panic, because if Germany is doing badly, then what are the chances for all the other countries in the Eurozone which have been struggling with big budget deficits and huge debts, which they can't really repay unless they have serious growth? So if a country like, which is in the news now, Italy, and countries like Portugal and also Ireland have debt to GDP ratios which they're worried about. If you look at what's been happening in Portugal, for example, even though it got a bailout and then came out of it recently because it was in trouble a couple of years ago, it has a debt to GDP ratio of over 100%. Now, how do you repay that unless you really grow quite substantially? Italy also has debt to GDP ratio of nearly 120%. Again, you need to have very fast growth to be able to pay the interest on it and to reduce that debt burden that you have hanging over you. Let alone Greece, which we mentioned, which has a debt to GDP ratio of nearly 170%. This compares with the UK, moving up itself, but having a debt to GDP ratio of only 85% shortly. Between 75 and 85% is the forecast over the next couple of years. So those countries have serious difficulties. With Germany not doing well, everyone started worrying. And in addition, there was this serious concern about prices falling in Europe. Not only actually inflation being reduced in loads of countries across the globe, including the US, but also in places in Europe, in some of the countries, seeing negative inflation. So prices are falling. So we have deflation. So the combination of the Eurozone growing very, very, very slowly, deflation emerging, which means that you and I will not go and spend today if we think prices are going to fall tomorrow. And then concerns about growth in China, which is slowing down very significantly, in India, which is also slowing down significantly, still all growing by 5%, but not enough to make up for a rising population and the increasing needs of their economies. And then you have other emerging countries like Brazil back in recession. Then you have Russia in difficulty because the oil price is coming down. And you have a bit of a panic in terms of where is this huge optimism that we have seen in the foreign exchange markets, but also in the financial markets for individual regions. How can that be justified? So we saw a complete reversal of this optimistic trend, which is really the issue that we've had to deal with in the last few days. Within that, then, you begin to wonder whether what we are worried about right now in this particular session is anything significant at all, because the panel is going to be discussing whether we're going to be having any other bubbles. My worry is that, if anything, we'll be moving downwards rather than upwards in a number of areas. Huge overvaluation of the financial markets in the past. Now believing finally that, or understanding that the economic situation is a bit different, and responding to it. Yes, loads and loads of very cheap credit around, which might create some bubbles. We're worried about housing market perhaps, but even that slowed down. So I think, if anything, what's happening is that there is too little finance rather than too much finance in the markets right now. People are not borrowing for investment, for expansion. There is a lot of risk aversion around, and we could, in fact, move into this vicious circle of downward spiral in spending, investment, and growth. And I think that's what we should be worried about more than anything else. Thank you.
Thank you, Vicky. Bill.
Thanks. Well, I certainly agree with Vicky that there was certainly a wobble last week. I would say it is a wobble in the bubble. I do think there are lots of bubbles around at the moment. And I think, in answer to the question we've been posed, is it going to burst again? Yes, very simply. If you push me a little bit further and say where and when, then I will defer to that great economist of mid-last century, Vera Lynn, and paraphrase her words. Don't know where, don't know when, but a bubble's going to burst again some cloudy day. The reason I'm sure a bubble is going to burst is because of something which has been going on for a longer period of time, which I say that we've been living in the West in a financialized economy for 30 years or so. Really goes back to the 1980s. And what I mean by that is an economy which, as Vicky has said, is very, very dependent upon debt. It's a debt-dependent economy. And in this sort of climate, debt-dependent economies are inherently prone to bubbles, and something will happen at some way. One way of seeing this is to see that what increasing debt does, and I would perhaps have a slightly different take on what Vicky said in saying there's not enough finance around. Actually, debt is continuing to rise at the moment everywhere in the West as well as in other parts of the world. Debt has never fallen since 2008. It's continuing to rise. When you have a lot of debt around, what that does is it creates a lot of financial assets. bonds mainly is what many of us focus upon. And it also, though, provides the means to buy those financial assets, the bonds, and the means to buy other non-producing assets like property, shares, and so on. And when you buy all these things, when there's a lot of debt-created demand, that tends to push up the prices. But then these higher prices of these assets, whether it's houses or bonds or shares, in turn makes people and organizations feel wealthier. And when they feel wealthier, they're able to spend more and also to borrow more. So more debt effectively creates higher financial asset prices, which creates the possibility for more debt, and the whole thing is a sort of self-reproducing spiral. Eventually, for some reason, some trigger, Vicky said perhaps it was Germany created the wobble last week, the different perception on the German economy, maybe something else. The trigger doesn't particularly matter. It's usually pretty arbitrary. But a trigger happens, and in a sense, economic gravity takes over, and the bubble bursts, and we have a financial crisis. American stock prices, I think, are very overvalued. I think bond prices generally, particularly what's called junk bond, high yield bond prices, are pretty overvalued. I think a lot of money went into emerging market government bonds, and some of those are pretty highly valued. So there's a lot of candidates at the moment. London house prices, others would say as well, would fall into that category. Now, given our shared experience of what went wrong last time when we had this big bubble bursting in 2007 and 8, and given the hardship of the recession that went afterwards, to predict that there will be another bubble bursting is a pretty dismal way to start, I suppose. But my main message that I want to make in my introductory comments doesn't get any better, I'm sorry to say, because I think there are bigger things that should concern us than a particular bubble bursting, whether it's American stock prices or London property prices. And that's because an even more important feature of our financialized economy, this debt-dependent economy, is that I think it's led us to view the West's economic problems, the West's economic malaise, through sort of finance-tinted glasses. We see everything through a financial sort of prism. We see our economic difficulties as somehow rooted in banking and in the problems of the financial system. And for me, that has been a very distracting thing, because I think for far, far too long, that narrow finance perspective has drawn attention away from where it needs to be if we're really to understand what's gone wrong in the economy, which is in production, which is in the state of productive decay, which has been going on for pretty much the same time as the financialized economy since the 1970s. Simply put, Western economies as a collective have not been producing enough to justify the levels of prosperity that we think we have secured. And that mismatch between our levels of prosperity we're enjoying and actually what we're producing can't last indefinitely. Now, we know, and Peter alluded to it or mentioned it, there's been a lot of talk recently about the weakness of the recovery, the unevenness of the recovery, the fragility of the recovery. It was a dominant subject at the IMF annual meeting last week and so on. But I think that misses the bigger picture and the bigger problem, which is that much of existing prosperity, not what's going to happen in the next few years, not the weak recovery, but much of existing prosperity in the West still rests on a financial mirage, still rests on all that mirage of debt. And while we ignore that, we ignore the fundamental questions of how we restructure, we reorganize, and we revitalize not the financial system, but production, because that's the thing that has created the need to rely on debt so much. And that's what we need to do, reorganize production, in order to start producing the wealth which can make up for that fictitious wealth. I think one of the main reasons for this, what I call a great evasion of the what I call the production problem, has been the illusion thrown up by this debt-dependent world that we are better off than we actually are. You know, for a long time, up until 2007, 2008, fictitious wealth, this paper wealth, whether it's in property prices or share prices or bond prices, gave us the impression that really the economies were doing pretty well. People thought early 2000s things were doing well in Germany and Britain and Japan even was getting out of its long-lost decade. America was doing pretty well and so on. But that was, I think, a bit of a fiction, because the real wealth was not being created at the same time. And even when the financial crisis hit, and even when we had those recessions, and even when we've had that very sluggish recovery since then, this hasn't led us to question this whole, what I would say is an upside-down world of financial dominance of the economy, alongside a sort of sidelining of what's going on in the production of new wealth and the production of new values. Instead, the focus has been very much, if you read the IMF and everything else, how do we fix the financial system? How do we sort out the banks and make them more stable again? How do we sort out the overhang of the debt problem? Do we write it off? Do we create inflation in order to erode it? How do we sort out the financial system is the way that it's seen. And I think that's the wrong focus, because I think fixing financial things, which have to be fixed at some time, of course, but fixing the financial things and focusing on that can't fix what brought about this debt-dependent economy. Even if you wrote off all these huge debts there, even if you find some way of doing that without creating a chaos, you still wouldn't be creating a production system which is strong enough not for us to become dependent on debt 5, 10, 15 years later. Because if you're not producing the values, society, business, the economy will turn towards debt, and that's what has to be fixed. It's like the opposite, to use a metaphor to illustrate my point, it's like the opposite of that satirical film, The Truman Show, if you remember it. Now, The Truman Show was an artificial world. This guy, Truman Burbank, I think, played by Jim Carrey, right? He's living this artificial TV reality show. And he begins to see signs that things aren't quite right. There's something wrong with this artificiality of reality. And he begins to pick up on clues and motivates him to try and escape from this. And that's the way the film ends. He breaks through the artificial dome and he escapes to freedom. What's going on in the economy is like the opposite of that. It's like we have the ending where Jim Carrey decides, having broken through the dome and seen that he is living in an artificial world, he says, no, let's fix it. Let's fix the dome and let's live in this artificial, unreal world. And that's the way we're doing things here in the economy. Things break. We've got lots of reasons to see that there are oddities, like what happened last week. We know that there's a great mismatch between real values and what's happening in the financial world. But instead of learning lessons from that, we try and fix it. We try and push money back into the economy. And as we saw yesterday and what the Fed Reserve said, what the Bank of England said, don't worry, we're here to put more money in. Quantitative easing may continue. Interest rates will stay low for longer. Leave Vera Lynn, it's more like Albert Einstein, that other great economist, wise man, his definition of insanity. You do the same thing over and over again, and somehow you hope it's going to turn out differently. It won't. The bubble will burst, and we'll have more problems.
Right, thank you for that, Philip. Philippa.
Great. Now, my business is in Hong Kong, and it's a wealth management business. So I manage people's money, and the combination of being kind of on China's doorstep and the vantage point of seeing what people do with their money just really makes me, on this topic, reflect on a couple of things. First of all, there's an unusual thing that happens if I, for example, if I have a British client who comes to us in Hong Kong. If I look at their portfolio before we've reconstructed it, we'll find that something like that, what is called home bias, happens in the portfolio, which means 85% of their existing investments will be in British companies. And if an American comes into us and asks us to look at their existing portfolio, 85% of their investments will be in American companies. And if you have a Hong Kong client come in, 85% of theirs will be in Hong Kong stocks. Now, of course, that doesn't make any kind of rational sense, because really what you would want to be doing is bearing in mind the relative size of economies, and of course trying to put your money in the ones that are going to grow the fastest. So what home bias teaches us is that people can get very short-sighted about really the size of the world and the opportunities that are in there. And I think one of the things that is happening, certainly when I'm here spending time in the UK, as I frequently do, I notice that all this very valid concern that exists about Europe forgets that that the world is not necessarily, well, in fact, definitely isn't going to stay in the status quo that exists at the moment. And what is the reason for that, and the reason that I keep optimistic, is that there is an extraordinary demographic change happening in the world. Between now and 2030, the consumer base of the world will double from 1 billion to 2 billion. And for sure, that is not happening in the United States, the UK, or in Europe. It's happening in other parts of the world. People also tend to forget that developed economies have the same weight as developing economies. It's about 50-50, the split. So also the developing economies are the ones of high growth. So you're looking at Africa growing at about 6, you're looking at China growing about 7 or 7.5. You've got Asia growing at maybe 5, which is very different to the kind of awful stagnant pool that Europe is stuck in for the various reasons related to the euro. So it's not a zero-sum game, and I think it's really important to keep focused on that. Growth comes from, essentially, in this case, it's going to come from more consumers. And this is a massive doubling that's happening. The other thing to understand, which I know is difficult to realize from here in the UK, is the importance of China's role and just how big it is. It's very hard to understand how big it is because it's all in trillions. We can't understand what trillions are. But let me illustrate it for you another way. If every time estimates of China's GDP are reduced by 0.1%, there's a lot of hand-wringing and head-clutching that it's dropped from 7.6 to 7.5%. But if you ask what the United States or the UK is growing at, people will say between 2 and 3. I mean, that's quite a big difference. And it's also 2.5 times slower than China. So to show the importance of this, first of all, be aware that the Chinese government Chinese economy is run by a centrally controlled government. And they have, because they don't have to go through the same hoops as a democratically run government, they can make things happen and they can push and pull levers that are not really possible in other economies. So they are slowing the economy because they want to. They are slowing down so that China can grow up. They are trying to transform it into an economy that is driven by its domestic consumer market instead of being an export economy. So it's not just happening accidentally, the slowdown. But to show how huge it is, when China was growing in the past 10 years, it would double. The economy would double every 4 years. Now, it is the second biggest economy in the world. You can't keep growing it at a 10% rate because it's chaotic. They're now growing at roughly 7.5%. If they slow their growth by 0.5% per year, all the way down to 4% over the next decade, they will still be twice as big as they are now, and bigger than the United States. It's difficult to understand this. If we look at the consumer emerging market, it's worth 7 trillion now. McKinsey estimates that during the next decade, that's going to rise to 20 trillion. Indonesia alone has got 74 million people. This will become 140 million people by 2020. Nigeria will be the third most populous country in the world by 2030. So the pie is growing bigger. The status quo is not going to remain the same. Africa alone this year will add another 220 million consumers. That's the same size as the US economy. So we've really got to keep this in perspective. The focus tends to be very much on the UK. Sub-Saharan Africa has the same GDP as the UK. China is 5 times larger than the British economy and growing 2.5 times faster, and it's bigger than the whole of Europe. So what this means is there's a rising tide of consumers on the way, and this is really the reason we should remain optimistic. This tide of consumers is huge, but will get bigger and bigger. Let me try and just give you some examples of what this means. If you look at General Motors China joint ventures, they bring in 6 times more income than its global operations. Chinese consumers bought 8 times as many air conditioning units as US consumers did. Chinese households saved $5 trillion this year. The US household saves $3 trillion. The best-selling beer in the world, you've probably never heard of it, snow beer, only sold in China. And China's on the move, the population's on the move. So there were 100 million overseas trips made by Chinese this year. That's 1 in 7 person traveling. So this is creating this tide of mass affluence, which is beneficial for all economies. And that's just China. It's not all of the other countries that there are, including Africa, Indonesia, and so on. So there are definitely difficulties in China, but I think that the point I want to start off by making is that the slowing down, or so-called slowing down, is not, it's misunderstood. And I know that the size of China is misunderstood, and you'll get talk about China's debt bubble. I remember watching on British TV, there was some economist, and I can't remember his name, he did a program to basically say what a terrible bubble there is. He shot the whole thing. He did it well. He wore a hard hat for most of the time. And he would place himself in front of cranes and massive buildings. And he would, look what they're doing. I mean, Wuhan, they've just built this city. You know, it's wrong. It's a bubble. But, you know, the saying, of course, that you can't build Rome in a day. Every 2 weeks, China builds a city the size of Rome. There are 200 cities in China with a population of over 1 million. So this is the kind of enormity that we're looking at. You've probably never heard of Chengdu, but it's a city that's twice as big as London. So I wanted to try and give some illustration about the size that we're talking about, and to not get overly focused on the important issues that exist elsewhere in the world, but realize that the status quo won't necessarily just stay like this. There is growth.
Thank you very much, Simon.
Thanks very much, Peter, and thanks to the rest of the panel. Well, I would start by suggesting that not only are there bubbles out there, but they're already bursting. In fact, we've seen quite a lot of bubble bursting going on in the last week or so. We've seen over the last, we've seen emerging markets being hit. We've seen, I mean, just have a look at commodity prices to see the unwinding of a bubble. Not just, you know, obviously oil's come off quite a bit, but you know, iron ore, soft commodities, grain. I think what happened over the last few years, you saw in the post-crisis response, we saw this extraordinary splurge of central bank money in the West, and that money was basically sent off all around the world, and it flowed into in Europe and the US. It flowed into government bonds. It flowed into inflated commodity prices. It went into emerging markets. And what happened about 18 months ago is that when the US started to signal that it was going to start turning off the monetary tap, that you started to see a reaction. You saw this taper tantrum in the emerging markets, and you started seeing quite a lot of volatility. And I think what we've seen the last few weeks is it was actually quite predicted. It was actually quite predicted, the response to that. You're seeing people, you know, the markets reacting to this turning off the liquidity tap. And I think that I would challenge Vicky, because I think that in a sense Germany is a symptom of what's going on rather than the cause of it. The German economy, for all its success over the last few years, it's becoming now quite apparent that actually it was essentially a play on the emerging markets, that its growth was largely fueled by this emerging market boom that was going on. So what's happened is that you've had a crisis response that started in America and Europe that has inflated bubbles all around the rest of the world. Now those are starting to unwind, and you're seeing the sort of blowback into the Western markets. So that's would be my proposition about what was going on last week and what's been going on over the last few months, why the Eurozone markets have slowed down. I think it's important to understand that. This is not a Euro crisis, the start of a Euro crisis in the way that we've understood it the last few years. This is part of a global picture. So my second proposition would be that the part of what we're seeing here is the result of I would suggest a major policy failure, policy error in the Western world. Within the economics world, there is a very clear understanding that the economic models that they've been using in policymaking world have been totally flawed. They understand that there's an active and ongoing debate in the economic world, and. But at the heart of these models that are used throughout the policymaking world is a focus on a demand-led view of the global economy, and that has led policymakers into a response that looks at every economic situation through the prism of what's happening to demand. So every slowdown in growth becomes a problem of lack of aggregate demand, and therefore the solution has to be what you do to stimulate more demand. Should you do a sort of Keynesian fiscal stimulus, or should you have more monetary policy stimulus? And that's essentially been the debate that's dominated the elite sort of academic level debate and the policymaker debate. And underlying that is essentially a fear of deleveraging, a fear of, and it also alludes to what Phil was saying too about the sort of financialization of economies, a fear of deleveraging, a fear of if asset prices fall too much, does that start to unwind the whole global banking system? A fear of deflation, do you get into a deflation trap, and does the economy start shrinking? That's what sort of underlies the models and what's underlied the policy response. I would suggest that this analysis is flawed, and that actually I think within the economics world there is a sort of heterodox community who increasingly, who are sort of trying to put an alternative view. But I think that is, and that would be a view that focuses on essentially on the balance sheets of, sort of looks at this through the prism of the balance sheets. And I think if you look at this alternative point of view, you would say that what caused the crisis, what's causing the current crisis, is this excessive build-up of debt. And that the only way you can deal with this situation is to restructure this debt and to as quickly as possible, and that the emphasis has to be on rebalancing the economy, and above all on removing the obstacles to future investment and to future growth. Anything that prevents resources being reallocated to, as Phil says, more productive bits of the economy, whether that's physical production or services or whatever, that is the challenge. This sort of neo-Keynesian view of the sort of policy-making elite, and I was in Washington for the IMF meetings, and that was sort of dominates all the discussions there. And the sort of, and I think that the motives are entirely honourable. That there's a view that you have this worry about deflation and deleveraging. You worry about unemployment. You worry about hysteresis effects. The idea that the longer people are unemployed, the more unproductive they become. So there's a sort of feeling that there's sort of the challenge is how do you get growth? How do you stimulate it? But I would argue that there's a danger that this approach is leading to bad outcomes. That by jacking up prices across the world in every commodity, this actually contributes to sort of a cost of living crisis in the Western world, because it inflates the asset values of the rich, but it means that normal consumers are faced with higher prices. But it also explains some of the bad productivity, because the resources don't reallocate from unproductive to productive bits, because zombie firms are kept in business, or people carry on businesses that should be restructuring their debts and reinvesting in new capacity. They carry on trying to sort of service old debts. So I think I think that's the sort of situation we've got ourselves into now in the West, where we've inflated all these prices, but we've struggled to work through this debt situation. To a greater extent, some countries have done better than others, but I think that's broadly the issue. And we have these big structural impediments to growth. And Vicky and I were on a panel earlier this week, discussing Greece, where we were discussing a very interesting book by a Greek journalist. It's such a good book, Yanis Paliogos, if anyone's interested in looking up. And he's written a very interesting book which manages to discuss the Greek crisis situation without ever once mentioning the ECB or QE or fiscal stimulus or whatever. He looks at it entirely through the prism of 10 individual chapters that look at the absolute horror story of trying to do any business in Greece and the difficulties that people face, the cronyism, the corruption, the government interference, the union interference. And I think that this is a problem throughout Southern Europe, and this is a particular problem. This is the real challenge, is that to a certain extent, all this fiscal stimulus, their focus on fiscal stimulus has covered up and obscured the need for these very deep structural reforms that are needed throughout Europe, both of the financial sector and of the way that markets operate to free up production. I've got 1 minute to go, and I would say that. So I said the question is, where do we go from here? And I gotta say, I would like to be optimistic like Philippa, and professionally I try to be optimistic, because I think that on the whole, that actually that bad things tend not to happen. That we do tend to muddle through. But this is my concern. My concern is that central banks are under enormous pressure. That the intellectual preponderance of this aggregate demand-driven neo-Keynesian sort of analysis is so strong that it's incredibly hard for central bankers to resist it. And one of them actually said to me in Washington, he said, well, the problem is that if we don't do the stimulus, that the governments will find someone else who will, that central banks are only as independent as long as they're doing essentially what the governments want them to do. And of course, on the flip side of it, to remove these structural impediments to investment and to restructure the debts is incredibly politically difficult and challenging, and that's what we're also seeing right now, and makes me quite concerned in the euro situation, is it's becoming increasingly apparent how difficult it is to actually sort out these structural problems, which is presumably what underlies Vicky's view that Germany may have to become more like Greece. I worry that we've seen in the last week, we've seen Fed governors popping up and saying maybe we'll have to delay QE. We saw what looked like a rather panic-stricken, response by the Bank of England's chief economist popping up with a speech and on the telly yesterday saying, we're going to delay raising interest rates. So immediately there's this sort of panic. So we can see immediately there's the knee-jerk response of we must continue to put more stimulus in, more fiscal stimulus, more monetary stimulus. And so I worry that even as the next set of bubbles are deflating in emerging markets, in commodities, in house prices in some parts of the world, we're already trying to sow the seeds for the next bubble. We seem to be caught in this spiral, this sort of loop of energy. At some point or other, I fear that it just becomes unsustainable. I hope we don't get to that point, but that's the thing that worries me.
Simon, thank you very much. I'm going to ask 3 questions of the panellists out of what's come up, and then we're going to go out to the floor. So my first question is to Vicky. I want to know whether you think, Vicky, that QE has led to a bubble in bonds that is unsustainable.
Well, I suppose that people know what QE is, which is basically the Bank of England buying bonds from the market, so allowing a lot of liquidity to come into the market. What it does, of course, it increases the value of the price of those bonds and reduces the yields, in other words, the sort of interest rate that's charged on them, if you like, if you calculate it properly once the price adjusts. But what it has meant is that interest rates at which people can borrow to invest for longer term have come down. And that has facilitated the pickup in investment that's taken place in the UK. And without that, I think we probably would have had considerably lower growth in the UK than the one we've seen so far, with fewer people employed and everything else. So it's very difficult in economics to work out what we call the counterfactual, which is what would have happened if this hadn't been the case. But I think we would have been in a considerably worse situation. Everyone who has reviewed the impact of allowing that money to come in at a time when there was fiscal austerity going on, so counterbalancing it up to a point, would say that things would have been much worse without it.
Okay. My next question is to Phil. If you go back 20 years or so, would you have been one of those people who said without manufacturing, which was then considered to be the productive area of the economy, that we were going to not grow, and that I think the argument has been somewhat disproved. In other words, that there have been elements of the economy, tertiary, service economy, whatever you like, that's actually shown to give a lot of value added. And perhaps a lot of the money that's come through the system is being invested in markets, and there's nothing wrong with that. These are surpluses. So do you think you would have been one of the gloomy people 20, 30 years ago on manufacturing?
I'm of that disposition, I think, yes. But I don't think I ever made the mistake of seeing that production is only manufacturing. I think, I'm trying to remember, I think if I go back 20 years from what I was writing then, I was making the point then that what we're talking about is production, not manufacturing. It's not a matter of trying to hold on to some golden days when you had these, shipbuilders in the West and steel plants and car plants that were running the world and stuff. There's a lot of ways that you can make value, which has got nothing to do with manufacturing. Most of the service sector is productive. I work in telecommunications. That's a business service in a way. It's a productive service. I think there's a very sharp distinction between services and financial services. And the extent to which there has been a shift of resources out of production, whether it's making things or making services, into financialized type activities, that shift, which has been going on steadily since the 1980s, does reflect a problem at the level of production. I say people tend to see things back to front, say the growth of the financial sector is somehow the cause of our problems. Too much money being frittered away in these socially useless activities of banking and stuff. The problem is, why did that situation come about? Why is that capital, which exists today, the cash is there, not invested in production? And you have to start from there. What are the factors, the barriers to production? Which then meant, yes, industries, businesses, these so-called productive companies, went into financial activities to keep their heads above water. Look at the huge banks which operate within so-called industrial companies. General Electric is one of the most important, GE Capital, but there's many financial divisions within industrial companies. So what I'm talking about is not a hard division between good value creating productive industries here and these parasitic, frivolous financial services there. I'm talking about a structural shift in an economy in which everyone has had to rely, the whole economy, including industry, had to rely on financialized activities to be able to function. But it's a con in the end. It's a fictitious world that is being created. And all I would say is that fictitious world can last a hell of a lot longer than people think. I think Simon's entirely right on this. Muddling through has worked extremely well for the last 30 years, and I, no better than Simon, can predict when the final implosion will happen. All I know is that that gap, which grows year on year between this fictitious world and the real world, is getting larger and larger. It can be managed almost indefinitely on an economic basis. That's why, as Simon said, you've had everyone piling in yesterday saying more QE, more low interest rates, because that can carry on. You can muddle through, but at some stage that mismatch has to create an implosion, and it's going to be an implosion for the West. I think Philip's entirely right. It's a very different world over in Asia and Africa.
Thank you, Phil. And my third and last question is just to Philippa, which is to ask whether or not there is a view that China has a debt problem, or whether it is something that it can live with and grow through, because obviously the growth is phenomenal.
Yeah, I mean, I think that would be one of the topics that's most talked about with China. And I think, again, it relates to the same thing about how difficult it is for us to understand how large China is and what its growth means. I think the best phrase I've ever read that describes it was by one of the journalists at The Economist, who said that China's growth makes molehills out of mountains. So take, for example, if you look back in 1998, actually in that time, 40% of China's loans turned sour. And cleaning up that mess at that time cost them 5 trillion yuan, which was 58% of that year's GDP. But if you look at it now, that 5 trillion is now 9% of its GDP. So, as Vicky pointed out earlier, one of the ways you get out of a debt situation is through growth. So, even if you look at China's growth numbers, yes, I mean, you can argue forever about exactly what that number is. But certainly it's not up there with the very big figures that we see to start with. And secondly, I think it's very manageable. I'm not saying that it's not a debt headache, but it's not a debt crisis.
Okay.
Yep.
That's a good answer, very clear. Okay, it's over to you now. So we'll have questions, but make points, but please make them briefly if you do.
I'd like to know if there are any parallels between the situation we find ourselves in now with QE and the situation in Germany between the wars with the hyperinflation. And I'd be interested in your comments on that.
Philippa, you spoke quite extensively about the role of China. Perhaps our over-reliance on China could bring the whole world down in its economy when the bubble next bursts. We've seen in Europe how we're quite reliant on Germany and the Eurozone. Whether you think that the growth of China and our kind of reliance on this could lead to a similar scenario affecting the whole world.
I have a couple of questions and I'll put them together. It did seem to me that there wasn't an awful lot of disagreement among members of the panel. But what didn't come out very clearly to me is what should be done to resolve some of these problems, and in particular, who is going to do it? Is it the states? Is it the financial system? Is it going to be the bankers? Is it going to be the regional organizations? Who are the key agents to bring about changes, to try to break this kind of deadlock in which the system seems to be caught up at the moment? And the other issue that comes up, I mean, are the old, to use the jargon, the neoliberals and the neo-statists, are these two polar opposites no longer relevant? Or is there still some usage in using these terms?
Philippa?
I think it really comes back to that statistic, which I'll say again, even if China consciously slows its growth by 0.5%, right down to 4% in the next decade, it will still double in size. And it's already most countries' first or second biggest trading partner. So it's, that is a slowdown in growth. But I think even bearing that in mind, to understand still the absolute increase in demand that generates. So my view would be that definitely that, I just don't see it that is, that's the danger.
I think there are some very interesting things about China that need to be said. I think there was a mention about Germany doing quite well until recently, and of course it links to the other question that was asked. Germany has benefited hugely from China growing when it did. very rapidly in the last few years because China wanted the types of goods that Germany produces. So Germany was in a very lucky situation of producing intermediate capital goods, which was exactly the type of stuff that China really wanted. So the export boom from Germany to China was really what led to Germany being so strong and having this huge current account surplus, which has developed, which is now 7% of GDP. So China was really, really important in that respect. China has been very important in another respect. Now, of course, that has stopped. And that's why Germany is in such a difficult position. The second thing, of course, is that China, because of globalization and because it now produced so many things until recently very, very cheaply, that's now changed, flooded the world with quite cheap products. It has kept our inflation low and has allowed us to grow faster. Just thinking about the hyperinflation earlier that was mentioned, has allowed us to grow despite very fast growth that took place for a number of years without any inflation really picking up. And that's been good news. So China has been very instrumental in that respect. It is, of course, all changing. I mean, China is becoming more expensive. Products which will be produced in China have now moved to Vietnam, to other countries as well, which are cheaper. Also, China itself is now moving away from investment in infrastructure, where the capital goods were really important, in terms of imports, into its own consumer products. It's becoming more of a developed country, which means that it doesn't necessarily want to import the types of stuff that we'd like to export to them for the moment. So it is definitely going to be a lot less significant in growth in the future. And I think we have to put up with that. And I think what's missing is demand from elsewhere. And the question that was asked, where does it lie? I disagree fundamentally with Simon here. Actually, there is a disagreement on the panel. I believe there is a demand deficiency that's out there, and that what you should do is indeed pump the economy full of money so that we don't get deflation, and change austerity measures in a number of countries and realize that debt needs to be rescheduled in order to get various economies moving again. We can't just rely on the US doing a miserable 2 to 3%, which isn't going to do anything to the rest of us. We can't rely on Germany because it's now not doing very well anyway. And we certainly, going back to the point, can't rely on China. Why are we worried that we're not doing it? Because the Germans are still obsessed about hyperinflation, which they saw between the wars. The sooner they get out of that obsession, the better.
Well, first, I think just on the last point, pick up on Vicky's just there, which is that I think we can probably agree there's a demand deficiency. The question is how you fill it. And I'm profoundly sceptical that pushing up asset prices through money printing or alternatively government fiscal stimulus through government borrowing is actually going to generate a sustained long-term pickup in growth, a sustainable long-term pickup in growth. It may give you a short-term kick, but I think actually long-term it probably makes the problems I was discussing worse. The only real way to sustainably fill this demand shortfall is to create the conditions in which investment can take place, and that means removing the obstacles to reallocation of resources and making sure you have a functioning financial system. But I wanted to pick up on the China point, because I think this is really important. I think that one of my gripes, having started my career working as a financial analyst and then writing about economics, one of the dirty secrets of the economics world is that it relies very heavily on extrapolation, and the financial world relies very heavily on extrapolation. So if something's been growing at 3% for the last couple of years, it carries on growing in the model for 3% for infinity. I would strongly, and so while I agree that there are many things that are exciting about what is continuing to happen in China, I would hazard a few words of caution about not just China, but all the emerging markets. And I think that what we're seeing right now is part of that, which is that the sort of structural problems I was talking about earlier, that these impediments to growth exist very, very clearly in these emerging markets too, if not even more so. Economists like to talk about the middle income trap. How do you get from being a sort of an economy that puts things together to being one that can create and innovate? And I think this is an incredibly difficult challenge for the emerging markets. It was hidden for the last few years by easy money and fiscal stimulus. But actually what we're seeing now with this slowdown is that these problems are becoming very clear. How do these economies, how do the emerging markets, how does China grow? And actually, if it's hard in a democracy to try and remove the structural impediments, if it's hard in a democracy to reform your labour markets, your product markets, to reform your corporate sector, to reform your banking sector, it's actually much harder in a dictatorship, which is actually in some ways almost hyper-responsive to public opinion or the sort of situation on the ground. It's incredibly difficult to do it in these. I think China's got some real challenges over the next few years. One of its biggest challenges, by the way, is demographics, which Philippa didn't mention, but I think China has a huge demographic challenge. But I think that China also has these very big, it says it wants to embark on this reform program to reform its economy, but one of the ways in which it's doing that is to basically try and stuff out dissent and try and make itself much more politically centralized. That's quite a sort of difficult trade-off to manage. So I would just be a little cautious about how extrapolation when it comes to emerging markets in China. I think that they have their problems too.
Thank you.
One of the mega trends that people talked about in the last sort of 10 years about convergence. And I think convergence is a myth, just as a foundation for what I'm going to say. The world is still really divided in two. And in terms of assessing problems and challenges, there are two different ways, two different frameworks to look at it. On the one hand, you've got the old world, the mature world, and my comments earlier were very much to do with the West. You have Anglo-America, Europe, where you have really problems of managing productive decay. That's what they're trying to do. The rest of the world is at different stages of growth. And many people have said the emerging markets as a sort of single term is quite misleading because there's huge different divergences within that. But broadly speaking, you have those two parts of the world. And one of the ways in which the old part of the world, the old West, is trying to cope with decay has been to rely on the values which are created in the new part of the world. Dealing with deficiency of value, which is what I was looking at earlier, there are two ways in which that's happened. One, the financialization, fictitious values. The other is the transfer of value from parts of the world which are actually creating value, like China, many other parts of Asia, Latin America, parts of Africa now, and so on. And you're right, it's been extremely important for the West to have that flow of value coming in. Talking about dependence on credit, we have to see the dependence on capital imports from China. China has been the source of American government spending for the last 15 years, right? The amount of government bonds, before the Fed started buying them all, but it's the Chinese who've been using part of their value to buy the bonds and allowing the American state to be able to fund its deficits, and on that basis allow the American state to be able to maintain its level of prosperity. So there's been huge dependence on that, and what we're seeing, just to conclude, the German example is a very good one. You can see when you pull away wasn't capital imports, it was exports of capital goods to China. When you see that prop pulled away from Germany, you see that Germany isn't much different to all the rest of the Old West, that it's got a problem within its productive sector. It's covered up by the fact that it could export to a very vibrant market in China. Pull that away, and you see that it's has got no clothes as the rest of the emperors of the West.
Whenever we hear about downturns in the economy, everybody immediately turns to central banks to say, what are central banks doing? Are we relying too much on central banks and not enough on other actors?
Thank you. My question is about central banks too, partly about Simon's comments about neo-Keynesianism and the central banker who said if we don't produce a stimulus, we might get sacked. Looking at the great unwind, we've been talking about it for a long time. It hasn't really happened yet. But what I wanted to ask is, what happens when it does happen? If central banks turn the taps off for good and proper, what effects will there be on all of us? Because I don't think there's been a huge amount of coverage about what will happen then. And it would be quite good for the sake of transparency to have some sense of what might happen then.
Apologies to Philippa. I sometimes wonder how much money I pay my financial advisor, whether it's good value for money. But look at everything. I've often thought, look at the pension problem, for instance. There are some very, very high fees going to the financial services. I'm not sure what proportion of the GDP financial services is. And indeed, could you sort of have a fraction of a percentage in a consortium of Berkshire Hathaway companies? But probably not, because I think that's very much a one-off. I think it strikes me a lot of industries had to restructure in the West quite considerably. With the financial services industry generally, it seems to have actually got away through the crisis almost unscathed. Now, partly that's because what do you replace it with? You have something called Occupy, but I don't know quite what they're advocating. If they're advocating some form of 1970 socialism, I think most people know that's not the answer. But is there a solution? Is financial services too high a proportion of the GDP? And if there's another crash, will they be hit in a way they weren't in the last crash?
To follow up on the question about who you think might be able to do something, my question is, I'd be interested to know the panelists' evaluation of something called the Group of 20,
which brings together the old G8, the advanced economies, and the developing countries on an equal basis, and they sort of have summits and so on. And some people think that it's been credited with making sure that the global economy didn't go into a massive depression as we saw after the 30s.
Okay, thank you very much. I'm going to ask the panel to think about the central bank's question in an additional context, which is that it's very unusually, because of QE and the like, if you take the UK as an example, the government hasn't had to think at all about its deficits or worry about it really, because they've got another chap in another part of the state giving them the money. So they've effectively being issued money to themselves. So arguably the discipline that ought to be in place on deficits, budget deficits I'm talking about, have not been in place. And I just wondered if anybody thought that was dangerous. Does anybody want to kick in on any of those points? Phil, briefly again, so we can get more questions in.
The central banks have got a lot of power, but they're also pretty impotent at the same time. It's in parallel to the question: is the Western economy too over-reliant on China? Yes, it's too over-reliant on the central banks as well. One of the great myths of the standard narrative about the Western problems of the last 7 years in particular is that it's to do with the state withdrawing from the economy, that it's to do with deregulation, that it's somehow the free financial markets got out of control. Too much excess, too much lending, too much carrying away, too much flouting of what minimal regulations were left, and as a result, this excess caused the crash. That is a myth. The whole financialization of the economy is the best expression of how dependent the economies are on state intervention. The financial economy would not be what it is if it hadn't been for the state, primarily the central bank institution of the state, pumping money in, not just in the last 6 years or whatever since QE, and QE itself is a bit overstated what it is. The important thing is easy money policies. The important thing is low interest rates being the liquidity mechanism of disguising that you're not producing any new values. Liquidity mechanism from the central banks, long-term low interest rates, is what's allowed us to maintain this mirage of financial debt. Ever since, maybe before some of your memories, but the 1987 stock market crash, ever since then, the role of central banks has been to dispense with its traditional approach, immortalized in the words of William McChesney Martin Jr., who said that the role of central banks was to take the punch bowl away just as the party gets going. Ever since the late 1980s, the role of central banks has been to pump money in whenever the party gets going. And if the party has problems, if the party ends in a disaster and everyone's got hangovers, what you do is you pump more money in. You give them some paracetamol, and particularly hair of the dog. You say, here, have some more money. Have some more money to get yourself back on the road again. So central banks have turned from being these prudent institutions which somehow moderated fluctuations in the economy to being the key device which has pumped money in to disguise the fact that there's not enough value being created. Okay, now, we shouldn't scapegoat them, but that's a symptom of how dependent, not just a debt dependency that we have today, but a state dependency. And that shows the spurious idea that we have a productive economy going on.
Okay, Simon.
Yeah, okay. So I think that the way you could always trace the origins of this current crisis, I think that everyone could have their different starting points, but I would say that one of the most crucial moments was in 1998 when the US Federal Reserve decided to come to the rescue of a hedge fund, quite a small hedge fund really, but it was worried that if this hedge fund was to implode long-term capital management, it would sort of bring down a whole host of other markets, and so it intervened to support it, and that was really the start of it. It then cut interest rates to prevent a dot-com crash, and then throughout the noughties, it was forever. It became known as the Greenspan put. There was a feeling that if there was ever any turbulence in the market, that the Fed would be there to lower interest rates. I think what we've got to a situation with now is that central banks, there's huge pressure on central banks. You've seen it this year really with almost the hysterical campaign to force the ECB to start buying government bonds. A move which I have to say I've spoken to, one way or another, quite a lot of the, top central bankers around Europe over the last year or so, and I can say that I can think of very few of them who really seriously think that buying government bonds would make really any particular difference, great difference to to the underlying problems in the Eurozone economy, but they're under enormous pressure to do it. It raises all sorts of legal issues, and it raises all sorts of political problems. What economists talk about is fiscal dominance here, is the expression they use. And that's what we seem to be getting to a situation with in throughout the central banks, where essentially the central banks have become subservient to the fiscal authorities, but also at the same time financial dominance, where they've become subservient to the financial markets too. So they're quite constrained by the narrative. I think there is a real issue. So somebody asked, several people have asked, and I think it's time to have a stab at answering. I mean, what can be done, or who should bring about the change? You know, the private sector in a lot of countries has done quite a lot to try and change within the parameters that it can. The best example perhaps is Spain, where the private sector there went really very rapidly from supplying the domestic market to building really impressive export growth, the most, actually outpacing Germany for export growth over the last few years. So, and across Europe, there are examples of the private sector trying to, of successfully reforming itself. A lot of the issues, though, concern the public sector, where it's incredibly difficult to reform. And I think one of the issues here is that governments like to try and do the easy things. I mean, the problem is that reform is very difficult. There are always winners, there are always losers. Taking on powerful vested interests is incredibly difficult. You end up with, there's huge demonstrations in the centre of London today. I mean, whatever you try and reform is incredibly challenging. And so, of course, what governments prefer to do is to, what they would like to do is to borrow more money, inflate away their debts. They would prefer to devalue their currency. They would prefer to put up trade barriers where possible. And in a sense, what we've done over the last 50 years is to try and stop politicians doing all those things and trying to create independent central banks or the World Trade Organization, or trying to put sort of debt brakes on what governments can spend. And governments don't like it because it means that although they have huge power, and they have huge power to make big political decisions to change the way the economy works, they don't like to use that power. And so instead they put all the pressure back on the central banks to try and do the easy things. And I don't think that ultimately doesn't produce a long-term solution, but that's the world that they inhabit and we inhabit.
Thanks.
It's important just not to simplify things too much, making caricatures of the evil bankers and irresponsible central bankers. And of course, the situation is actually much more complex than that. The other issue which tends to come out is that this kind of false belief that there's going to be a cure and then everything will be fine from then on. I mean, I've been advising clients for 20 years now, and goodness knows how many crises we've been through. I think to some extent we've got to accept that it's the nature of how the world works, that you have an overshoot on the way up, and then there's a correction that comes down, and up it goes up again. But if you actually take a chart of global stock market and you plot it back as long as you can, you'll see that you can actually more or less draw a straight line through that. Of course, when you zoom in, you're seeing a lot of movement on either side. But we need to get away from this belief that there is a solution there and then we'll never have to worry again. And I do very much agree with Vicky that I think the central banks did the right thing to step in. Everybody has forgotten with myopia of how bad it was in 2008 and how bad it was in 2011 with the European crisis. So yes, it's created a situation where there is QE, which is an unprecedented experiment that we don't know is how it's going to end. But we do, to some extent, have to muddle through to keep going.
Thank you. And Vicky, briefly, so I'd like to go out for more questions.
It is worth remembering what actually happened, which is that we entered, after a period of a lot of credit growth, a crisis which was a credit crisis. Very unusual type of crisis where there was no money in the economy. Banks were not lending. Banks were not trusting each other. There was no interbank lending. The financial system looked like it was going to collapse. And yes, it accounts for some 10% of GDP in this country, of course, very significant. If you add other things, it accounts for more, all the peripheral services. But what was more important than that is the influence on the economy, on the rest of the economy itself. And lots of economists, I have to admit, in their forecast, their macro forecast, didn't have the banking sector in it for some strange reason. Now they're revising all the forecasts because it's such an important part. So So the central banks had to intervene, especially since, for a while afterwards, we started with the austerity measures, which of course forgot the fact that there was no lending taking place in the economy. Lending has been declining in the UK, has been declining very recently, has been declining in most European countries. And cross-border lending, so for trade, has collapsed. And that's why trade is not really expanding significantly, because nobody trusts the sort of letters of credit written in a different country. So QE is here to stay and will stay for a while, and I don't think there's going to be unwinding. I think what can happen, after all, we just heard the US ready to start again, and there's already, is it nearly 2 trillion of money that has been spent through QE in the US. There's about 375 billion here of pounds. They were winding it down, of course, reducing the amount every month that they were purchasing. Now they might put it up again. But I think certainly for the UK, my view is that when it comes to those bonds that they have, needing to be redeemed, there will be some other bonds issued. I just don't think there is any risk at all of suddenly the Bank of England withdrawing 375 billion from the market. Not at all. The G20, which was asked, which I have to answer, I think you're absolutely right. Very good question. I was working for the government at the time, and of course Gordon Brown decided that G20 was going to be the forum that he was going to use to get the economy moving again. I think it was 2009, there was a meeting held here in London, which really united everyone in terms of lower interest rates, intervening to save the banking system, huge recapitalization required, nationalization of banks. And what resulted with that, of course, is moral hazard went out of the window. Lehman's should never have happened. We economists were running around saying that politicians are never going to let Lehman's go because it's going to be a disaster in the world economy and the banking systems everywhere will collapse. They must be rational, they won't do it. What did they do? They let it go. Did they let anyone else go seriously after that? No. So it has proved to be the case that everyone has now realized how important the financial sector is. And I'm afraid it's here to stay, and it should be here to stay.
We really discovered how mutually or how integrated different institutions were across the world, and that's another thing that scared central bankers into wanting to act. But that integration itself may be dangerous, of course, and regulation of it is the solution that's being given. More questions, please.
Yes, the Labour government did save the banks here in the United Kingdom. And among the economies, there has always been a controversy about the way in which the crisis was handled, in the sense that a lot of economists would argue that they could have let some banks go. But anyway, the past is the past. What worries me is the future, because if I follow there is some consensus among economists that the bubble is going to burst again. And I just want to ask you, how can, especially the UK government, really deal with something like this? Because some economists would argue that they don't really have the resources to save the banking sector, because the banking sector in this country is very significant. And if there were to be a real bubble where you have about 40-50% of the stock market crashing, could the government still intervene to save the banks? I'm not an economist, so I don't understand, but it is a debate among economists. Can you please address this question?
Shouldn't the governments of any persuasion really have the courage to stand up to the debt on banks' balance sheets and deal with that? Your point about balance sheets.
How far is this a question of trust, as you've hinted at, and how far are we seeing that trust being restored, if at all?
So we mentioned how horrible the situation was back in 2008. But the problem is we're looking not... So obviously it was a good thing what the central banks did, is generally a consensus. But the problem is we're looking at what's going to happen in the future. Now the thing is from 1993 onwards to 2008, there was a 368% growth in the financial service industry in the southeast of England. Now the problem is who are economies there to serve? They're there to serve and raise the living standards of all the individuals in a nation. Now this is my problem, is that the growth of financial industries was solely in one particular area. The majority of lending, which Vicky's talked about, which declined, was interbank lending. So in effect what we're doing is we're creating this Ponzi scheme where we're raising a load of money and it's effectively helping one group of people. Now admittedly, there may be a trickle-down effect there. However, for the vast number of people, what are we actually gaining? And maybe Phil's right, maybe we need to focus a little less on the financial and look at production, because actually that can help a vast more number of people.
Just to take up on what Vicky was just suggesting, I wondered whether that is a suggestion that the next option is a write-down on debt if they're going to reissue bonds, what that was to suggest.
There is no doubt that we have tended to undervalue manufacturing, for example, and it's not. I mean, the truth is that although it only represents about 10 to 12% of the economy, it actually creates loads of extra jobs and is also much more productive and much more export-oriented. So we need more of it. The lending that I was concerned about that was falling is lending to firms. I was talking about lending to firms and to SMEs. The reality is that a lot of the large firms have tended to, and have continued to be able to, if they wanted to, borrow in the markets through corporate bonds and issuing debt or whatever it is that they were doing. So they could do it that way. Smaller firms can't really do that and rely on their banks. And if the banks don't help them, and if they're too Southeast England centred, and if they don't understand the specific needs of regions, which has really happened, then they're just not going to lend the money. And then there is a real issue about growth. And I think you, of course, have a point. I think the gentleman over there was probably asking about restructuring of government debt rather than necessarily bank debt. Well, of course, I don't think there is any chance of that here. I think the issue here is that the government can still, despite everything that happened in the last 2 days, borrow very, very cheaply in the markets through issuing more bonds itself at low rate, long term, and that's what it should do in terms of stimulating the economy. It comes back to a question asked: who should be, intervening in the market to make sure we get back to growth? I think the government has a very significant role to play on. Infrastructure spending, for example, has to be financed, in my view, that way, and the markets would completely accept it. Borrowing to finance for capital investment is, I think, a very good thing. Now, on the banks and what will happen to them in the future, which I think is a very, very important question, and of course, the trust issue is very much linked to it. I think in the UK, we have recapitalized the banks reasonably well, have developed bad banks. So we moved a lot of bad assets into other banks, and they've been selling them. In fact, that's been happening. And we did close some banks in the sense that they were integrated into others. What has happened in other countries is that similar things, I mean, for example, where I come from, there were 18 banks a few years ago. There are only 4 now. There's been huge consolidation and a lot of money put into recapitalizing them. No bad banks created. There's similar problems in some of the other countries. There is an asset quality review that the European Central Bank is doing right now. And I think we are finding already now that there is quite a lot of mistrust between UK banks, which think they're doing better, and some of the European banks, which they think are going to find that they need to either recapitalize or close. So I think there's going to be a bit of a turmoil in Europe the moment we see the results of those asset quality reviews, because non-performing loans in many countries in Europe are 30 to 40% of the balance sheet. It's absolutely huge. And then stress tests that will happen, looking at different interest rates, different growth rates. So I think we're in for a continuation of this banking crisis. It hasn't gone away. And of course, we will be touched by that. There is no way that the UK banking system will be completely insulated from this. So I think it's worrying times ahead.
Okay. Phil,
I'd reinforce my point that we should, take off the finance-tinted glasses. There are a lot of problems in finance, definitely, but fixing the financial problems or writing off a lot of debts is not going to solve the more fundamental problem, which is the dearth of new value being created. I mean, 2 points on what Vicky said, because I don't see the problem even in the way that's being presented, that it's the banks not lending enough to startups and to SMEs. For a start, banks have never been the best source of funds for startups. I've been involved in a couple of startups. I'm sure all the people on the panel in the room have been. Banks have never been favourable to helping startups. That's not changed. You have to find money from elsewhere. You beg, borrow, and whatever to be able to get the money to set things up. And when you're being successful, then the banks will be there to lend you a bit of money. But that's very helpful after the event. It is not the reservations of the banks which is holding back the economy. We can also make the point that most big companies who also do historically a lot of the investment are very cash rich, and they're also very easy to borrow, as you say, whether on the bond markets or from banks. And what are they doing? They're not investing in physical plant and equipment or new factories. What they're doing is they're borrowing money at the moment, even though they are cash rich, and they're using it for buybacks. It's a short-termist myopia of the extreme. So we have to get to that problem of not whether the banks are helping the rest of the economy and playing their traditional role, but why is it that production economy is not investing in the future even when there is the cash around, and even if the banks were able to lend to them? There's something more fundamental at fault there. And I think that allows me to come in on the question of the who can fix things. And it's not so much who, it's how we can fix things. There are two ways of dealing with this problem. Either, which is not a short-term thing in some ways, we can either continue to muddle through for a long time. I've of the view that we can muddle through much, much longer than anyone thinks. I think the bubbles can carry on again and again and again. And what will happen is that somebody will come in to pick up the pieces and to pump in more cash. I mean, a slight little bit of rewriting of history on QE, if I can just put my two penneth worth in. When QE was launched by Bernanke in late 2008, it was a short-term measure. It was designed to be a kickstart to the economy because it was designed to ease that credit squeeze that was going on, or that credit freeze that was going on. It was designed to be a short-term thing to get things moving, and that's characteristic of how the muddle-through economy works. There's a problem back in 2008 which is seen as so urgent, so extreme, the state has to do something to get things moving. And then that responsive short-term measure becomes the new strategy. And QE now, we're not even, we're talking about tapering it now. We're now hearing from Bullard yesterday and others, no, I think we might have, we might revert it. We might go on again. QE3, QE4 they're talking about now. So those short-term muddle-through things then get extended and extended, and so we should see that QE is just a symptom of an economy which can muddle through. But all the time that you're muddling through, you're not fixing those underlying problems. And I think the problem in the high is there has been, what this reflects is an abdication of responsibility, really, going back 30, 40 years, that governments who do have a role to play in this very much so, in alliance with the private sector, governments have abdicated responsibility of trying to get that growth going again. They've cut back on research and development, they've cut back on public investment, they've cut back on anything which could be helping to generate and create the conditions for the private sector to grow. And they've abdicated that, and instead they just muddled through, and that muddle through will go on until at some stage, and I agree with Simon, my last point, at some stage though, I don't know when, I don't know how, but at some stage, that gap between the financial resilience of a state pumping more and more money in will break with that financial weakness or the economic weakness underneath. And then it's going to be, hard times.
Thank you very much.
If I look back again on my 20 years, I can't think of a period of a number of years that I could string together where it was smooth sailing. The European government's approach is really running around with a sand bucket and a fire hose and some sticking plaster. And in contrast, if you look at the complexity of China's economy, it is big and vast, but they have a 5-year plan which they have articulated and are executing. And I think that really is one of the main differences. We see a pullback in markets and panicked response to try and make everybody think it's okay, which is not a plan or the execution of a plan.
Okay, Philippa, thank you very much. And Simon?
Yeah, so I don't think that anybody really questions QE in the sort of 2009 type incarnation, where essentially the central banks at that point were acting as sort of market maker of last resort, which was a sort of perfectly valid thing for them to do. And the difficulty came where later on in various further iterations of QE, where it became a monetary policy tool that the central bankers could never really explain quite how it was going to work. The Bank of England started out with 3 different channels, and then it became 5 over the, and the justification constantly shifted. And I think that, so underlying this, though, it lies, to come back to my earlier comments about this fear of deleveraging and deflation as being something that had to be countered. And I would argue strongly that I think that a lot of this is misplaced, that actually deleveraging is not something to be feared, but it's essential. And that deflation is something, again, not to be feared, but it's actually quite healthy in the current economy. So we shouldn't be worried about the fact that lending is contracting. What we should worry about is the composition of lending. So if overly leveraged companies are paying back their debt, that's fine, so long as companies that are growing can get access to new debt. And that puts the banking system, I think, right at the heart of all this. I think that the UK has done a pretty good job on recapitalising its banks. I don't think that we should be worried about this sort of southeast issue. I think the whole country needs a healthy financial system. So I think that the UK has done a good job. Now, the big question is, has the Eurozone done a good job? Is this ECB exercise going to be sufficient? And for me, there are 2 issues there. The first is, will they have enough capital to restructure their debts? And the second one is this structural issue again. Does the legal framework in these countries and does the judicial system in these countries enable the banks to then push through and restructure these debts? That's going to be the absolutely key challenge. I'm concerned about that. But I think that it's essential that we see this, because actually because trust is essential to the financial system, and the only way that we can restore trust in the financial system, in the global economy, and prevent what at the moment is a very dangerous fragmentation that could be is a really big risk to the global economy. The only way to trust it is for each country to fix their economies, to get to a situation where investment and where healthy companies can grow, where investment is taking place, and where you can normalise economic policy. And I think it's very interesting, if you look at the IMF's latest forecasts, the countries that are growing fastest in the world, countries like the US, the UK, even smaller countries like Ireland and Latvia, are the ones that took the toughest actions over the last few years to restore their economy. And if you look next year as well within the Eurozone, the countries that are going to be growing fastest in the Eurozone, places like Spain, Portugal, even Greece, are the countries that have been forced to make these big changes. The problem we've got is that countries like Italy and France are not making these changes. And this is why I said in the column that Peter referred to earlier, why I think we're coming to this very important ideological moment for Europe. Because if the French and Italian sort of thesis, the sort of neo-Keynesian thesis wins out here, and we get this new round of stimulus being poured onto fundamentally broken economic models, then I think we're going to be in a very dangerous place of sort of endless QE and bubbles, which we'll never be able to get out of. So I really hope that we can, I think we can muddle through, providing we get these reforms to these economies, because that is ultimately the only way we're going to get the sustainable growth, rebuild the trust.
Thank you to the panel. Could I ask you to thank the panel in the normal way, please?